Section 11 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Chapter 4, Deregulation Redux. Part 1, Expansion of Banking Activities, Shatterer of Glass-Steagall. By the mid-1990s, the parallel banking system was booming. Some of the largest commercial banks appeared increasingly like the large investment banks, and all of them were becoming larger, more complex, and more active in securitization. Some academics and industry analysts argued that advances in data processing, telecommunications, and information services created economies of scale and scope in finance, and thereby justified ever larger financial institutions. Bigger would be safer, the argument went, and more diversified, innovative, efficient, and better able to serve the needs of an expanding economy. Others contended that the largest banks were not necessarily more efficient, but grew because of their commanding market positions and creditors' perception they were too big to fail. As they grew, the large banks pressed regulators, state legislatures, and Congress to remove almost all remaining barriers to growth and competition. They had much success. In 1994, Congress authorized nationwide banking with the Regal-Neal Interstate Banking and Branching Efficiency Act. This let bank holding companies acquire banks in every state and removed most restrictions on opening branches in more than one state. It preempted any state law that restricted the ability of out-of-state banks to compete within the state's borders. Removing barriers helped consolidate the banking industry. Between 1990 and 2005, 74 mega mergers occurred involving banks with assets of more than $10 billion each. Meanwhile, the 10 largest jumped from owning 25% of the industry's assets to 55%. From 1998 to 2007, the combined assets of the 5 largest U.S. banks, Bank of America, Citigroup, J.P. Morgan, Wachovia, and Wells Fargo, more than tripled, from $2.2 trillion to $6.8 trillion. And investment banks were growing larger too. Smith Barney acquired Shearson in 1993 and Salomon Brothers in 1997, while Payne Webber purchased Kidder Peabody in 1995. 2 years later, Morgan Stanley merged with Dean Witter, and Bankers Trust purchased Alex. Brown & Sons. The assets of the 5 largest investment banks, Goldman Sachs, Morgan Stanley, Merrill Lynch, Lehman Brothers, and Bear Stearns, quadrupled from $1 trillion in 1998 to $4 trillion in 2007. In 1996, the Economic Growth and Regulatory Paperwork Reduction Act required federal regulators to review their rules every decade and solicit comments on outdated, unnecessary, or unduly burdensome rules. Some agencies responded with gusto. In 2003, the Federal Deposit Insurance Corporation's annual report included a photograph of the vice chairman, John Reich, the director of the Office of Thrift Supervision, OTS, James Gilleran, and 3 banking industry representatives using a chainsaw and pruning shears to cut the red tape binding a large stack of documents representing regulations. Less enthusiastic agencies felt heat. Former Securities and Exchange Commission Chairman Arthur Levitt told the FCIC that once word of a proposed regulation got out, industry lobbyists would rush to complain to members of the Congressional Committee with jurisdiction over the financial activity at issue. According to Levitt, these members would then harass the SEC with frequent letters demanding answers to complex questions and appearances of officials before Congress. These requests consumed much of the agency's time and discouraged it from making regulations. Levitt described it as, quote, kind of a blood sport to make the particular agency look stupid or inept or venal, unquote. However, others said interference, at least from the executive branch, was modest. John Hawke, a former controller of the currency, told the FCIC he found the Treasury Department exceedingly sensitive to his agency's independence. His successor, John Dugan, said statutory firewalls prevented interference from the executive branch. Deregulation went beyond dismantling regulations. Its supporters were also disinclined to adopt new regulations or challenge industry on the risks of innovations. Federal Reserve officials argued that financial institutions, with strong incentives to protect shareholders, would regulate themselves by carefully managing their own risks. In a 2003 speech, Fed Vice Chairman Roger Ferguson praised, quote, the truly impressive improvement in methods of risk measurement and management, and the growing adoption of these technologies by mostly large banks and other financial intermediaries, unquote. Likewise, Fed and other officials believed that markets would self-regulate through the activities of analysts and investors. Quote, it is critically important to recognize that no market is ever truly unregulated, unquote, said Fed Chairman Alan Greenspan in 1997. Quote, the self-interest of market participants generates private market regulation. Thus, the real question is not whether a market should be regulated. Rather, the real question is whether government intervention strengthens or weakens private regulation, unquote. Richard Spillenkoven, the Fed's Director of Banking Supervision and Regulation from 1991 to 2006, discussed banking supervision in a memorandum submitted to the FCIC. Quote, supervisors understood that forceful and proactive supervision, especially early intervention before management weaknesses were reflected in poor financial performance, might be viewed as 1. Overly intrusive, burdensome, and heavy-handed, 2. An undesirable constraint on credit availability, or 3. Inconsistent with the Fed's public posture, unquote. To keep checks and balances and keep any agency from becoming arbitrary or inflexible, senior policymakers pushed to keep multiple regulators. In 1994, Greenspan testified against proposals to consolidate bank regulation. Quote, the current structure provides banks with a method of shifting their regulator, an effective test that provides a limit on the arbitrary position or excessively rigid posture of any one regulator. The pressure of a potential loss of institutions has inhibited excessive regulation and acted as a countervailing force to the bias of a regulatory agency to over-regulate, unquote. Further, some regulators, including the OTS and Office of the Comptroller of the Currency, or OCC, were funded largely by assessments from the institutions they regulated. As a result, the larger the number of institutions that chose these regulators, the greater their budget. Emboldened by success and the tenor of the times, the largest banks and their regulators continued to oppose limits on banks' activities or growth. The barriers separating commercial banks and investment banks had been crumbling little by little, and now seemed the time to remove the last remnants of the restrictions that separated banks, securities firms, and insurance companies. In the spring of 1996, after years of opposing repeal of Glass-Steagall, the Securities Industry Association, the trade organization of Wall Street firms such as Goldman Sachs and Merrill Lynch, changed course. Because restrictions on banks had been slowly removed during the previous decade, banks already had beachheads in securities and insurance. Despite numerous lawsuits against the Fed and the OCC, securities firms and insurance companies could not stop this piecemeal process of deregulation through agency rulings. Edward Yingling, the CEO of the American Bankers Association, a lobbying organization, said, quote, "Because we had knocked so many holes in the walls separating commercial and investment banking and insurance, we were able to aggressively enter their businesses, in some cases more aggressively than they could enter ours. So first the securities industry, then the insurance companies, and finally the agents came over and said, 'Let's negotiate a deal and work together,'" unquote. In 1998, Citicorp forced the issue by seeking a merger with the insurance giant Travelers to form Citigroup. The Fed approved it, citing a technical exemption to the Bank Holding Company Act. But Citigroup would have to divest itself of many Travelers' assets within 5 years unless the laws were changed. Congress had to make a decision. Was it prepared to break up the nation's largest financial firm? Was it time to repeal the Glass-Steagall Act once and for all? As Congress began fashioning legislation, the banks were close at hand. In 1999, the financial sector spent $187 million lobbying at the federal level, and individuals and political action committees, or PACs, in the sector donated $202 million to federal election campaigns in the 2000 election cycle. From 1999 through 2008, federal lobbying by the financial sector reached $2.7 billion. Campaign donations from individuals and PACs topped $1 billion. In November 1999, Congress passed and President Clinton signed the Gramm-Leach-Bliley Act, or GLBA, which lifted most of the remaining Glass-Steagall era restrictions. The new law embodied many of the measures Treasury had previously advocated. The New York Times reported that Citigroup CEO Sandy Weil hung in his office, quote, "a hunk of wood at least 4 feet wide, etched with his portrait and the words, 'The Shatterer of Glass-Steagall,' unquote." Now, as long as bank holding companies satisfied certain safety and soundness conditions, they could underwrite and sell banking, securities, and insurance products and services. Their securities affiliates were no longer bound by the Fed's 25% limit. Their primary regulator, the SEC, set their only boundaries. Supporters of the legislation argued that the new holding companies would be more profitable due to economies of scale and scope, safer through a broader diversification of risk, more useful to consumers thanks to the convenience of one-stop shopping for financial services, and more competitive with large foreign banks, which already offered loans, securities, and insurance products. The legislation's opponents warned that allowing banks to combine with securities firms would promote excessive speculation and could trigger a crisis like the crash of 1929. John Reed, former co-CEO of Citigroup, acknowledged to the FCIC that, in hindsight, the compartmentalization that was created by Glass-Steagall would be a positive factor, making less likely a catastrophic failure of the financial system. To win the securities industry's support, the new law left in place 2 exceptions that let securities firms own thrifts and industrial loan companies, a type of depository institution with stricter limits on its activities. Through them, securities firms could access FDIC-insured deposits without supervision by the Fed. Some securities firms immediately expanded their industrial loan company and thrift subsidiaries. Merrill's industrial loan company grew from less than $1 billion in assets in 1998 to $4 billion in 1999 and to $78 billion in 2007. Lehman's Thrift grew from $88 million in 1998 to $3 billion in 1999, and its assets rose as high as $24 billion in 2005. For institutions regulated by the Fed, the new law also established a hybrid regulatory structure known colloquially as Fed Light. The Fed supervised financial holding companies as a whole, looking only for risks that cut across the various subsidiaries owned by the holding company. To avoid duplicating other regulators' work, the Fed was required to rely to the fullest extent possible on examinations and reports of those agencies regarding subsidiaries of the holding company, including banks, securities firms, and insurance companies. The expressed intent of Fed Light was to eliminate excessive or duplicative regulation. However, Fed Chairman Ben Bernanke told the FCIC that Fed Light, quote, made it difficult for any single regulator to reliably see the whole picture of activities and risks of large, complex banking institutions. Indeed, the regulators, including the Fed, would fail to identify excessive risks and unsound practices building up in non-bank subsidiaries of financial holding companies such as Citigroup and Wachovia. The convergence of banks and securities firms also undermined the supportive relationship between banking and securities markets that Fed Chairman Greenspan had considered a source of stability. He compared it to a spare tire. If large commercial banks ran into trouble, their large customers could borrow from investment banks and others in the capital markets. If those markets froze, banks could lend using their deposits. After 1990, securitized mortgage lending provided another source of credit to home buyers and other borrowers that softened a steep decline in lending by thrifts and banks. The system's resilience following the crisis in Asian financial markets in the late 1990s further proved his point, Greenspan said. The new regime encouraged growth and consolidation within and across banking, securities, and insurance. The bank-centered financial holding companies, such as Citigroup, J.P. Morgan, and Bank of America, could compete directly with the Big Five investment banks: Goldman Sachs, Morgan Stanley, Merrill Lynch, Lehman Brothers, and Bear Stearns, in securitization, stock and bond underwriting, loan syndication, and trading in over-the-counter or OTC derivatives. The biggest bank holding companies became major players in investment banking. The strategies of the largest commercial banks and their holding companies came to more closely resemble the strategies of investment banks. Each had advantages. Commercial banks enjoyed greater access to insured deposits, and the investment banks enjoyed less regulation. Both prospered from the late 1990s until the outbreak of the financial crisis in 2007. However, Greenspan's spare tire, that it helped make the system less vulnerable, would be gone when the financial crisis emerged. All the wheels of the system would be spinning on the same axle. End of section 11.